Okay. Hi, everybody. Good evening. Thank you so much for joining us today. We have a new exciting series on the Endowus Live webinars. We're launching a new series called Endowus Access. And we're very excited to have our partners, PIMCO, the largest fixed income managers globally, joining us today in a special session of Meet the Experts. The title is Reading Bond Markets with a $2 trillion Heavyweight. And yes, it's a bit of a clickbaity title to rope you guys in. So I hope that a lot of people will be joining us today for a really fun, insightful, and interesting webinar. So I'm really excited to have with us today Stephen Chang, who is an EVP at PIMCO. He's a portfolio manager and the most senior fixed income portfolio manager across Asia. So really excited to have him join us today. So Stephen, would you like to say hi to the audience?
Thank you, Sam, and hi to the clients of Endowus, and very glad to be here. Thank you for the invitation.
Okay, great. So as we get going, I wanted to just start with our usual disclaimer. And today we'll have two because we'll have a PIMCO presentation with another disclaimer to make it exciting for you guys. Once again, we're on YouTube and Facebook Live today, but you can get access to great Endowus content on webinars. It can be the whole gamut from FMCs to famous bloggers who join us. The Work Salaryman is a great partner of ours. Also Lou, who is the founder of the 1M65 movement, has joined us recently about how to become a CPF millionaire. So please subscribe and press the button below, and we'll follow up with wonderful content in the future. An up and rising great content and blogger is InvestQuest. So Peter O, the co-founder of InvestQuest, will be joining us. He comes from the industry. I think he's from JP Morgan. I think Stephen also from PIMCO is ex-JP Morgan Asset Management. So Peter is an ex-JP Morgan investment analyst. He set up this new blog, which has done really well. And Sheng Shi, our personal finance lead, will be joining Peter on a special session about ETFs versus unit trusts, cracking the code for early investment success. So please join us next Wednesday at 7 p.m. on Endowus Live. Just a quick introduction to Endowus Access. So what is Endowus Access? As you can see on the slides on the right, we have had sessions with PIMCO before and also Dimensional. And sometimes we've had investors and fund managers on our webinars. But we've decided to take the webinar series in a different direction. And Endowus is all about advice, access, and cost. One of the most important access is to great investment products, best-in-class funds that are not normally available sometimes here in Singapore to individual investors. So what we're doing is inviting the top fund managers, strategic partners of Endowus, like PIMCO, who have been with us from the very beginning. And we secure access to better insights and also advice through the Endowus Access webinars. So it's about gaining insights from the pros, the professionals who invest day to day. I've now left that field, but Stephen's still in the thick of it, managing billions of assets, looking at macro and bottom up as well. So this institutional investing professionals will be joining us to share with us their insights, their outlooks, market views, and the institutional frameworks within which they invest the pools of assets that they manage. So we're really excited about this Endowus Access series. It will be a bi-weekly series starting from today. So Endowus Live will be more focused on personal finance. We'll have other speakers like Lou, like the Work Salaryman, and like Peter from InvestQuest joining us and kind of sharing the experience of trying to invest as an individual investor. The personal experiences, the difficulties and challenges and great insights and tips and hacks that will help you become better investors as individuals and managing your wealth. But Endowus Access will really be focused on the professional aspects of investors and will invite great investors from the region, from some of our top partners like PIMCO. Just a quick introduction about Endowus. Most people joining us will probably be clients of Endowus, but we always get a decent portion of new people joining us on these webinars. So I'd like to introduce Endowus to you. Starting with me, I am the Chairman and Chief Investment Officer of Endowus, one of the founding partners. I've been in the industry for about 26 years now, of which 17 of which was with Morgan Stanley. And I was on the asset management side, like Stephen, at Morgan Stanley Investment Management, where I was in the public market equity space, mostly for Asia and emerging markets. I was the Chief Investment Officer, and then I became the CEO and managed the business across Asia for several years before I retired and moved into this new space of fintech. Now, Endowus is born out of our pain, the pain of trying to invest our own money as individuals. The moment I step away from my, job as an institutional investor, I become just another poor individual investor, and I suffer from the tyranny of incumbent financial service providers, whether they're banks or brokers or fund platforms. And the cost of investing here in Asia, across the region, and especially in Singapore and Hong Kong, is exorbitantly high. And it's nothing like the institutional level access we get when working for large institutions. So we're really about trying to solve this problem for the individual. Our mission is to help people, including ourselves, invest better, to live easier today and live better tomorrow. And we became the first and only digital advisor for CPF, which is the Singapore Total Social Security System. It took us a while working with the CPF board, with the Ministry of Manpower, with the MAS, the regulators, to get there, to be the first and so far only digital advisor for this pension money. But we have access across cash savings and SRS, and PIMCO investment products are available to our clients and able to access institutional share class through us for cash and SRS. As I said, we became the first and only CPF digital advisor, but we are focused on three things, which is advice. So we're very strategic in our approach to asset allocation and investing, very evidence and scientific based rather than trying to speculate, and holistic in trying to manage your whole money. And really focused on trying to solve the biggest generational challenge that we face as a society, which is retirement adequacy. And also we provide institutional access, sometimes exclusive. We bring products into Singapore that were not available previously. And we stand on the shoulder of giants. A lot of these robos try to build products themselves as a fund manager. But we believe we have great partners in fund managers like PIMCO, and we don't have to reinvent the wheel. We work with our strategic partners to bring in the best-in-class funds and best-in-breed products so that our clients can access it at really low cost and receive advice from us in building the appropriate portfolios for their needs and their goals. And the cost is really important. As we always say, cost is the other side of the same coin of returns. So if you can reduce costs, then returns are boosted and it leads to better outcomes for all investors. So we have a clean, all-in, completely aligned to the best interests of the clients structure in terms of our fees, one flat fee. We have innovated the 100% trailer fee rebates, which is the kickback commissions that distributors receive from fund managers. And it's a travesty, and because I'm from the same side, but fund managers actually get paid much less than the distributors, which is ridiculous in our view, because the hard work of managing your money and investing is done by the fund managers, and they deserve much more. So we work with partners, fund management companies, who are basically going to be receiving their fair due. We will receive what's due to us, and the broker will as well. So we're completely aligned, and we are all working towards succeeding for the investor. One final plug, admin issue, is the Slido poll. So since a few weeks ago, we've moved away from YouTube Q&A, the chat room, because it's great, but unfortunately it's difficult to see through the questions. The Slido poll actually helps you ask the questions, and then you can also actually upvote the questions inside, so that the questions that you think should be answered first will be moved up. And it helps us as presenters to go through that systematically and answer the questions that is most needed to be answered. Endowus Fund Smart is the platform that we've built on top of the advised portfolios that we had before, target risk-based portfolios. And then we launched Cash Smart, which is managing your short-term liquidity through cash management accounts achieving higher yield at low risk by using cash, institutional cash products and money market funds and short duration fixed income products. And FundSmart is a platform where you have the ability to customize and personalize your portfolios. And we're really excited to launch the Endowus Ultra Defensive Portfolio, which sits between the 100% fixed income advised portfolio, which still during March and during 2008-9 would have had a meaningful volatility. And certain clients have said that that is not the type of volatility they can stomach with a 100% fixed income portfolio. And yet the Cash Smart Enhanced portfolio, which is targeting about 2% yield and utilizes money market funds and short duration funds, is too low yielding and too low risk for certain people. So we've plugged that gap. So we placed this portfolio, which is now entitled the Endowus Ultra Defensive Portfolio. And you can see there that there's some overlap with our core advised fixed income portfolio. And the bulk of the fixed income portfolio still will be dominated by PIMCO's wonderful products. So this is a plug for PIMCO and a plug for the products and also the Ultra Defensive Portfolio. We've just launched the Low Duration Income Fund. We brought that into Singapore with PIMCO. It's a new version, a low duration version of the flagship income product. And it's supposed to provide you with income as well as low duration, less risk and less volatility than the income product. And that's Sing dollar hedged, institutional share class, exclusively beginning with Endowus customers. So we brought that into Singapore and released the product together with PIMCO. So really excited about that. And we're really plugging that gap in the middle. And I just wanted to show this one final chart before we go to Stephen, who everybody actually dialed in for. So this is the Ultra Defensive Portfolio and how that fits in as a strategy between the Cash Smart Enhanced 2% targeting yield and the core fixed income portfolio, which is a little bit more volatile, but still a wonderful portfolio. We've plugged that gap in the middle with the Ultra Defensive Portfolio. So if you feel that markets are concerned, you're concerned, or you're reaching retirement and you need to more secure your pool of assets, or you have some liquidity needs, but you still want some yield above and beyond the Cash Smart solutions, then this is a product for you. And you can actually just go into the platform, add gold, select the funds, input the weights, and you're good to go. So with that, I'll switch over to the presentation sorry, I'll just get this changed. And Stephen can begin his presentation. So Stephen, maybe we begin with a quick introduction and then we'll move into the slides.
Sure thing. So thank you very much for your already very kind introduction, Sam, and welcome to everyone again for this webinar. So my name is Stephen, and I've been in the trenches for quite a long time. You can see that I've been in this investment management business for 24 years, but I'm still enjoying every day of it. I have been working since my graduation in different locations. I spent my early part of my career in New York City, managing bonds already at the time. At the time would be the US dollar block market, some of the emerging market from Latin America. And then I spent time in London. And then since the early 2000s, I have moved back to Hong Kong, where I grew up, and have been running Asian fixed income portfolios. So I joined PIMCO in 2018. I was very much attracted by the broad fixed income capability, which I think is second to none in this investment management business. So I'll introduce to you more about how PIMCO is set up. And once I go through that, then I think we can go to the Q&A afterwards to see what questions you might have for me and PIMCO in general. So Sam, if you don't mind moving a couple of slides forward, maybe I can give the audience a bit more about how PIMCO is set up. So first of all, PIMCO, we believe managing money is a team sport. And because we are covering many markets around the world, we have teams kind of spread in different locations, in different continents, in different regions. so that they can be in a location that best suit the specialty that we need for looking after, for researching those assets. So on the ground knowledge is very important, and that's why we have so many offices, as you see on this map. And we have roughly 3,000 employees around the world, with about, call it 900 people in what we call the investment professionals. So these are our portfolio manager, our researchers, our risk manager, along with many of our advisors. So a very, very strong team here. And we also have a lot of numbers on the side, but I think the key for us to share with you is we are very much invested in every field that we participate in. We are fixed income focused. We look through very much the whole spectrum of fixed income, from public to private. We do very much of a deep dive into all the credit analysis, and we also have a lot of analytics and quantitative related people too. We think we only can do that well, with this type of resources, and it's very hard to set up and replicate. Maybe I'll go in a little more detail on the next slide about kind of how the process work to pull all of that together. So some of you might know PIMCO as a macro house, but we think we do top down and bottoms up really well. And you need both of them to create alpha and a good risk adjusted return stream for our clients. So the way we are set up, you can see on the top half of the page is about the top down process. And then we also have a lot of the bottoms up, and I'll tell you a little bit more about what each of them entails. But in a nutshell, we have 3 different components that make up of our key investment process. On the top left, you see what we have in terms of the economic forum. So we have quarterly meetings, or 4 meetings a year, where all of us in the portfolio management field meet together and try to hash out a view to anchor ourselves as the roadmap when we invest every day. So we have the cyclical outlook, which typically look at the next 3 to 6 month view. And also we have a secular outlook, which I also share some output with you a little bit later on, that think about the next 3 to 5 years. We don't want to miss the big picture. We don't want to miss the big trend. So having these as an anchor is very important. And then on the top right, you see we have a body we call the investment committee. So this is made up of this most senior investor, the chief investment officers of our firm, and they distill the different insights from the investment team into guidance and themes for all of our portfolios. So they get some of these themes and specific knowledge from our bottoms-up research. So this is something that we do every day. We go to that on-the-ground knowledge from the various team to try to draw kind of the read-through while we put together recommendation for individual instrument, for individual country. We have a lot of discussion and then get filtered through the investment committee to arrive at what we think are appropriate for the portfolios. So to put it a little bit more into less abstract term, maybe the next slide can give you something a little bit more of a clear guidance. So in this kind of the themes I already mentioned from our forums, and we, by the way, publish quite a lot of these forum insights and viewpoints through our website, and so please take a look at them when you have a chance. So these are the key outlooks that anchor our views, and they would be translated into 5 key risk vectors that we would be guiding through all of our portfolios. So the direction of interest rates, actually at this point, the conclusion is more of a range-bound market in interest rate, which also leads to the second vector, which is also important, about volatility. There are a lot of fixed income instruments where you are inherently taking a view on volatility, because as you sell volatility, you actually get carry and you get fixed income as a result. So volatility is also a very important viewpoint. The shape of the yield curve, whether we're expecting the longer dated bonds versus shorter dated bonds, how they perform against each other. And then a couple of other vectors which are also important includes our credit allocation. How are we thinking about corporate bonds or other products that offer a additional spread against the risk-free rate? And then individual country outlooks will also drive many of our portfolio setup. So this translates into guidance for all the portfolio managers to operate. So we usually have a bias on these different vectors, and then individual portfolios, depending on the guideline and the implementation by the portfolio manager, then they can be operating within these targets. And you can see on the portfolio construction, we do have a lot of optimization then done in this basis, also taking into account risk controls and liquidity that the client might need for the respective combination. So let me tell you a little bit more also about our top-down, the macro process. So on the next page, you probably see a lot of pictures of people that you are very familiar with. And these 7 very much of a world-leading experts are on our global advisory board. So former Fed Chairman Ben Bernanke is chair of our global advisory board, along with many of these household names who give us insights about topics ranging from monetary policy, which is very important for our fixed income investments, to political view. You see names like Gordon Brown, Anne-Marie Slaughter, and they are very much in the ex-government or ex-State Department to give us their view and also their the current conversation around what's going on in that circle. So very important for us to understand, especially with a different geopolitical tension popping up, populism sentiment popping up, and how that might drive government policy. And these are people that are kind of very engaged with us throughout the process. So one example would be when there is a Fed FOMC meeting, right afterwards we get the statement. The investment committee will be having video conference with Ben Bernanke to see what his read about some of the underlying message, what are the other options ahead for the Fed policy, and how to interpret certain things like what we have just recently heard about the new framework, such as the flexible average inflation targeting. There are other experts here that would give us other flavors, but they are very much involved. They're participating in investment committee meetings. They're participating in our forum process. So they are asking questions just like everybody else, and our expert could be having this kind of very nice exchange with them to see what the latest conclusion for investment implications should be. And then maybe to pull it a little closer to our region, you can also see the resources that we have in Asia. So we have 20 plus portfolio managers and researcher in this time zone, spread across 4 different trade floors that we have in Japan, Australia, Hong Kong, and Singapore. And we are utilizing the resources globally to invest. And for the portfolio manager and researchers, including myself, we are focusing on the Asia markets because this is our time zone. We can go, although COVID make it a little more difficult to travel and to kick the tires, if you will, on company visits. But this is something that we have been doing for a long time. We're building that network with company management, with sector experts to know all these industry in and out across that supply chain. So there are a lot of expertise being built here. And while I had introduced my own bio and experience before, we have also experts of many different fields. So, for example, we have an analyst on property, and property is a very big part of Asia credit market. And this person would have had spent time on the sell side and also with property consulting, and that's
Looks like we've lost Stephen. He's coming back. Hi, Stephen.
Hi, I think there was some unstable internet connection. My apologies.
Okay. No problem. Glad you're back.
So so maybe I can move to the next page then, Sam. I need to make sure we get even more bandwidth for our internet today. So the way we look at investments is we need to set up a platform, and you already heard me tell you about how many people and what kind of expertise we have built up in Asia. So and in all the markets that we operate, we want to find out what can we build in terms of having an enduring competitive advantage. So in Asia, as an example, we will be building a very dedicated portfolio management team, and we'll be integrating with this PIMCO global investment process. And this really gives us more insights than our competition, who may only have, let's say, Asia only house, and they might not have the global perspective. We'll also be building advantage over, let's say, people who are doing it DIY with themselves, or with maybe even passive product, which they may not be able to take advantage of all the opportunities. Because in fixed income, we very much believe that an independent view would be an important edge that we have. So in the middle, you see an independent credit ratings being highlighted here. There are rating agencies, and while we respect their views, we also think we can be more forward-looking than they are. And as we anticipate some of the credit outlook and events to happen, we can preposition ourselves in expectation of upgrades or downgrade, which would result in a pretty big jump in bond prices. And also another part about fixed income is we have to build a lot of access to issuer, first of all, to get the latest management view, but also to allow us to participate in a very active way for primary markets. So for those of you who are more familiar with stocks and equity, for a company, there's only usually one stock, and you own it and you like it, and you can kind of review it a little bit later on. But for fixed income, the companies would come with many different variety of bonds. There could be senior bonds, subordinated bonds. There could be different maturity bonds of different structure. And because of the frequency also they come to the market, we will be able to take advantage when we see an attractive new issue, and we can switch out of a perhaps something which is more expensive. And that actually is a pretty high maintenance activity that I think active management will be able to build and capture alpha from it. And so if you can kind of help me move to the next slide or the next section, I would like to share a little bit more of the view that has come out of our secular forum process. So this is something that we do on the secular side, meaning 3 to 5 year view. We had this discussion back in September, and some of the conclusion it's been captured here, not only for this year, which we titled our piece "Escalating Disruption," but also what we had built over the year. So this has been a process that we have done for many years, and so it's a time-tested process to identify some of the really big themes that we have. So maybe just from the earlier days, maybe around 2009, a term that we coined here, although you've heard it in many other places by now, is the new normal. So new normal at the time to us is the world is going to adjust to a lower growth, ahead. And so the new normal in terms of growth and also for interest rates, it will be something that we have to change our mindset about. And as we progress through the years and update our secular view, maybe just to look at 2019, before a lot of the disruption, we were anticipating a lot of this to be brewing, and we need to be able to set up our portfolios to be flexible enough to anticipate potentially some of the risk area to help deal with this disruption. And this year is a reinforcement of that theme about the escalating disruption. And you see that disruption actually have made a pretty big dent in terms of the growth picture. We have measured that real GDP in this stylized graph. And so while we are having a V-shaped type recovery ahead, there could be more disruption, judging from the secular themes that we have identified. And those themes include, in the next page, the four disruptors that would be with us for quite some time. The tension between US and China, or China rise as a superpower, that would be bringing both opportunities as well as risk in some areas. Populism is something that we have seen across many countries with protests, with perhaps the more far left and far right politician winning elections. And so that is also something that could be very much of an impact, and sometimes negative impact to investment generally. Technology is something that we also think will drive a lot of the changing world. This year in particular, we're doing this event on video conference and then through the internet rather than in person. But this could be, kind of the usual norm for the next, kind of how many years ahead now before we can have safe travel again. Climate is also a very super secular trend in our view, and there could be implication for us to think about. And I would weave a little bit of the ESG investments, how people invest, and how many of the bank lending or even investor lending that might have environmental and climate impact, and that might be a guideline that a lot of people would need to abide by in terms of not funding some of the more polluting type industry. Other swing factors in the near term meaning the next 3-6 months, would be how the public health situation and the virus will be controlled. So vaccines are something that we watch very closely about that development, whether that could be scaled up and bring forward or not the growth recovery for the next year. And then fiscal policy. Fiscal policy has been a big help to help with the layoff or furloughs. People are still getting paid, but how long would that last? Will they help in terms of kind of lessening the scarring effect, so people won't feel so pessimistic and will be changing the trend growth for many of the countries going forward. And so what are all of those in terms of implication for us? So I already highlighted a little earlier that we anticipate interest rate to remain quite low and be more in a range bound in the near term. So the monetary policy side, we think they're quite trapped. And you look at the central banks, they are already at their effective lower bound for many of the countries, and will likely stay there for some time. So what they would do is on asset purchases and other non-traditional manner. But that's also perhaps kind of getting used to by the market, or is somewhat reflected. So the next swing factor, as I highlighted earlier, would be more on the fiscal side. And that's why the U.S. election, it's still something we need to watch. Depends on whether you believe the president counting of ballots are completed or not. But the key is still the Senate in the U.S., for example, whether it's a Republican control or Democratic control Senate. So there's still runoff in January that's near the watch, and that would have a very strong implication to the fiscal side. And maybe I can skip through this slide and then talk a little bit more on this one. Apart from the range-bound rates market that I already have highlighted, we think some inflation hedge may be attractive to have in the portfolio. Central bank policy has been very accommodative, and in fact, they have pre-committed to be very accommodative for quite some time. The Fed, I mentioned about the flexible average inflation targeting. That would mean they want to wait till full employment and for inflation to go above their 2% target for some time, perhaps before they will consider hiking rates. So inflation, if they are successful, should go up. We are also watching for some of the supply, in particular in commodities, whether they will not be doing as much investment over the last year or so, and will leading to when demand comes back, then you have a supply shortage, and that might also get inflation up. It's not perhaps in the next 3 to 6 months. Inflation trend is still looking pretty well behaved or at a pretty low level. But over the more medium term, that could be something that could surprise people. And at this point, if we look at the credit market, if we can kind of change a little bit of the focus here, then we also see the impact on the monetary policy. So we had a pretty big range this year on the credit spreads of different kinds. So here, just to make sure everyone get the acronym, so we have the agency mortgage-backed securities. Those are the Fannie Mae, Freddie Macs of the world. Some of the non-agency mortgage-backed, so they're not guaranteed by those agencies, to investment-grade corporates, the IGC, the high yield, HY, and emerging markets. This current spread level, the gray dot, is pretty near the bottom. So there has been quite a lot of liquidity generated by the monetary policy. People are seeking income. People are favorable towards fixed income in general, and there has been quite a lot of demand and pushing these spreads to be lower in general in the historical terms. So finding that income in a very low yielding world, it's what we try to identify every day for some of these unique story. But we think this will stay with us for some of these tight spread as this situation continues. And then also on the diversification benefit, I talked to you about the low yield, and while there's a lot of demand, some people would typically, ask me and ask PIMCO in general about, okay, so is there still a role for fixed income? And our answer is very much yes. So fixed income can first of all bring you a positive carry, and on top they could provide quite a lot of diversification benefits. So here you can see having a, call it 60-40 balanced portfolio with 60% stock and bond and then bonds, you actually can produce a similar return with a reduced volatility, so a better risk-adjusted return. And during time when the equity market does particularly poorly, such as the first quarter of this year, you can see the typical fixed income bellwether indices, such as the global aggregate, actually posted positive returns when S&P was down sharply. So you can have this kind of balancing out to keep your portfolio more robust with the fixed income in your portfolio. And I also want to share a couple of things on the Asia credit side. It is an area where we see quite good opportunities. And maybe we can move to the next slide from there. I think the valuation, particular when we compare Asia credit market versus comparable US, on the left-hand side would be investment grade. On the right-hand side would be the high yield. The blue line is the Asia spread level, and you can see the spreads are higher than the US. You pick up roughly 70-odd basis points from owning Asia investment grade over US investment grade. On the high yield side, even more pronounced. It's over 2% extra that you get from owning Asia. There are some technical reason why this is the case. The Fed has been generating a lot of liquidity. They also have corporate kind of buying program earlier in the year, providing that backstop. And so there has been a lot more demand for the US credit assets than the Asia assets. But these valuation over time, we are plotting here 5-6 years worth of history. You are getting much more spread than prior periods. So that in itself is a pretty good cushion. And if we look at the fundamental side, also we would say Asia, particularly China, growth is much more robust compared to other regions. There is a better control of the public health situation. The GDP growth this year will still be positive when others are in negative territory. And companies in general are also more robust and operating more normally than some of the more disrupted sectors or energy sectors in the US side. So something to watch out for. I think it's both offering value and also fundamental backdrop. And then if we look at it on a slightly longer term scale, on the next page here, the Asia, both in terms of investment grade on the far left or the Asia high yield, they stack up really well on this risk return table. So they are more on the efficient frontier of it. And so this is something that you can perhaps take away as a reference point when you look at Asia credit as well. On top, we also see the issuance and a very expanding market on the next page in the Asia credit market. So there are more and more new debut issuer in this space, and we are able to extract alpha from doing that on the ground deep dive research with these companies, picking up the attractive issuer that we can put into our portfolios. And maybe with that, I also want to tell you the demand also seems to be stronger and stronger coming through in Asia from domestic investor. So what we have noticed is before, maybe 10 years ago, Asia market is more of a, we sometimes call it a tourist market. So global investor think about Asia booming at the time, they invest, but then on the first sign of trouble, they get out. But it has developed over time that there are a lot more dedicated money from investor here or for dedicated money. And so the green bar in the middle is the investor that treat Asia more as a core. So when things such as certain headlines hit across or certain issues, these are not going to be assets that people just dump at, kind of indiscriminate prices. So that's a very healthy market that we have picked up, and we think this is a very healthy development. So perhaps with that, maybe Sam, I'll pass the ball back to you, and maybe we can field some Q&A.
Sounds good. Thank you so much, Stephen. That was really insightful and wonderful to hear how PIMCO manages money from a top-down and bottom-up perspective. And also, the inner workings of, how you, evaluate and look at certain sectors and geographies as well. Clearly, fixed income has been a great diversifier, especially in the volatile markets like this year. So I think maybe the first question is very pertinent. And it's been asked by two different guys on our Slido questionnaire. And the first one is, how did PIMCO manage the bond portfolios during the liquidity crunch back in March and April? And then there was a similar question which asked, how did the funds fare during the 2008 or 2009 crisis? And so I think maybe, the right way to frame it is to look at it from a macro backdrop, top down, what happens in a crisis typically in fixed income markets, and how does PIMCO navigate through those, volatile periods, especially when fixed income markets, we saw in March a very, very huge disruption, liquidity tightening up, people selling US dollar fixed income products, major disruptions to pricing in the fixed income markets. So maybe just a top-down macro, how does a crisis play out? And then maybe within that, what are some of the things that PIMCO looks at and does during those periods of volatility?
Sure, I think that's a very good question. So I shared that even after last year, kind of our secular outlook is that we need to be dealing with disruption. So we need to be prepared for market volatility. In a very real sense, that translated into our risk management process. So for our portfolios, whether that be for kind of more broad-based mutual fund products to segregated accounts for our clients, we would be looking at a lot of the cash cushion or something that can be converted to cash very quickly in order to kind of withstand this type of volatility. So there is a usual number that we deal with, and around February period when we see the COVID starting to spread more globally, and that translated into disruption for ourselves. More on a personal level, we are wondering whether we should go into the office, whether we need to switch to work from home, and the investment committee meets. One of the conclusion is this will first of all create volatility because the liquidity being provided will be much less as a result of this disruption. People not going to the trade floor. The natural thing is they cannot communicate as well, perhaps at the time. And the first thing is everyone cut risk, cut inventory, cut trading positions, and no one would be willing to take on more risk, and that would be pretty horrible for risk assets at the time. So the reaction from the investment committee is we need to up that what we call some of the true cash level, something that we need to be providing our clients. If they need to redeem, we need to be prepared for it. So we crank up that cushion, and that's applying for all the portfolios across PIMCO. So that, first of all, reduces the risk of the portfolio, and secondly, it allows those redemptions to be made, and we want to make sure our trading and execution platforms are all equipped, first of all, to handle the volume and to be able to match our orders in the most efficient way possible, and utilizing our strength in terms of being one of the largest fixed income manager. We have a lot of bargaining power with our counterparties to demand some of the liquidity be provided, or at least at a tighter price than what a typical fund house might be able to get. So we are really making sure that is the number one priority, a risk management mindset. We move as a firm together in a very integrated way. And then as we kind of look beyond kind of March and April, we also utilize our platforms, kind of the expensive nature of it, that we see flows. So we see clients actually, first of all, in March, have started to demand liquidity, and we have fulfilled all those liquidity without problem. And then by April and May, the spread levels are very wide, and is pricing in a doomsday scenario in a way for a lot of companies to be in distress. There are a lot of forced seller. So we think those spread levels becomes very attractive, and that's from a secular sense that things are going to perhaps maybe not quite reverted to the old level, but certainly there will be some sense of normalization. So how much of that should be priced in, and how much should we actually start to take some risk, especially when the flow started to turn with the liquidity program. We are seeing very clearly some early signs from our client flows as well. So we started to again, take advantage, utilizing the setup that we have on the primary issue. A lot of companies want to be able to provide that flexibility. So even though it might be expensive to raise debt, they are coming to the market, and we are happy to provide that line to them in order to take advantage of it.
Oh, those are great answers, and I just want to second that idea that scale is so important when it comes to fixed income investing. Being at that scale of where PIMCO is really drives a lot of advantages in terms of execution, in terms of being able to be nimble. And unlike equities, I think most people, get this the wrong way around. People think that equities market is significantly larger than the bond market, fixed income market. But globally, can you confirm that the fixed income market is much larger than the equities market globally, right?
Yeah, when we can also play in different parts of the world. So you shouldn't be just looking at US dollar market. We're involved in euro, yen market, and increasingly in the Chinese renminbi bond market as well.
Yeah.
So we are building our portfolios usually with the most flexible mandate. So it's like where we get the best ideas, where we get the best opportunity, and be able to add that extra for on top of the benchmarks.
That's right. Okay, great. So the importance of scale is really important in fixed income. And I think unlike equities, where I think people do say that there's diminishing returns to scale sometimes, you're not able to put money to work in the small cap companies and stuff. Fixed income, actually, the scale constraints actually don't exist in the way that the equities market exists. So for a large manager like PIMCO, I don't think there's many constraints to being able to deliver the long-term returns that you have been delivering with trillions of assets.
That's very, very right. And we have that negotiating power with the companies. We can even demand them they increase the protection, the covenants of what we buy in the bonds. And then we are a critical participant, so we could be 10, 20, 30% of the deal size. And that also it's some of what companies kind of can feel like we understand the business, and maybe there is a bit of a funding gap, and we'll be able to provide that to help them tide it over. Because longer term, the business model is sound. Maybe they had a little bit of this disruption from COVID or other factors that have caught them unprepared. So we kind of look into this, business model, whether that's something that would prove to be a profitable and sustainable enterprise. And so for the research that I mentioned about the independent research that we do, one of the key components is to model up the financial projection for the next 2-3 years, sometimes even beyond if it's in an industry that we have more predictability. So this really help us, kind of knowing the fundamental picture and how much of our lending or our buying of their bonds will help them through, and then that help us find the valuation that's appropriate.
Yeah. So it's opportunistic, investments are possible. There's also a very active component to that versus, traditional, thoughts about passive, because we know that fixed income passive doesn't work as well as equities. And equities, traditionally is an asset class where 75% or more of active managers underperform. But in fixed income, largely because of PIMCO, but the percentage is much higher in terms of the outperformance of fixed income managers in active versus passive. I think these are the types of opportunities that allow that, right?
Yeah, I think it's also something which I don't know if is obvious to the audience here. For fixed income, since you're roughly being paid a coupon plus some changes in the risk profile, what you want to do is to avoid the losers. So you want to avoid those that might go into deterioration, that might becomes downgraded, or maybe even default in those cases. So you are trying to avoid, the 20-30% that might get into trouble for that. So for us as active manager, those are things that we believe we do quite well. For equity, on the other hand, you might need to identify that 5% winners. If you don't identify those winners, then you might trail the index by a lot. And this year, you see the equity is very much led by a very narrow band, mostly tech or other kind of companies that might benefit from a pandemic, which beforehand you might not be able to choose the right ones.
Great. Maybe just a switch in tact and related to a question in Slido about how the current bond valuations heavily inflated by central bank policy, in brackets. Is this asset class still a good hedge against stock market volatility? And you showed a good chart earlier, and maybe I can show it again. But Related to that about valuations, I think there is some divergence between, you showed how the US markets and developed markets, we've had a very sharp pullback in spreads and yields have continued to go back to pre-crisis levels. Whereas Asia and other markets, we haven't seen that, and the spread has widened from developed markets. So there seems to be a different response. But overall, there does seem to be a lot of liquidity. QE and all the people talk about money on the sidelines, how cash is trash, we need to put it to work. And so what are you seeing in terms of the flows and the liquidity, and what is the impact to fixed income markets? And this divergence between developed and emerging markets in Asia, is Asia and emerging markets, especially, eventually, do you think, and you've answered that earlier a little bit, but do you think those will eventually come down to levels that are pre-crisis levels, and that's the opportunity you see?
Yeah. So on bonds in general, they are trading at pretty low levels, and we have all seen that zero, it may not be a lower bound in some countries. So that depends a lot on how the monetary policy got executed. So there are people who thought Japan government bonds from 20 years ago at 3% was never going to get lower, and then they went to zero and they go negative. Similar for European bonds. So fixed income can still provide a hedge, even if the yield absolute level might sound low. And secondly, we ourselves also look for kind of the better kind of longer term picture based on some of the real yield valuation, for example. So in Asia, we actually see more higher real yield being offered for fixed income. So real yield is the normal yield minus the inflation. So you actually gain on top of what the inflation picture might be. And China would be one of the market where we're looking at very closely. The 10-year yield is north of 3%, around 3.3% today, and we see their scope right there. The central bank, they have not been as aggressive this year, but if anything were to be surprising on the downside, there is this diversification where they can still cut rates and fixed income can perform really well. So we'll be identifying countries with this type of asymmetry to add exposure to our portfolio.
Great. Just on this, the question was also about whether this asset class remains a good hedge, and people have talked about the demise of the 60-40 diversification portfolio. People have said that bonds and equities correlations have gone up, and therefore it's not a good hedge. But we've seen, and I think you had a slide in here as well, and I can try to find it for you. What the US equity drawdown versus the Barclays Global Ag number did during the whole of Q1. So in terms of crisis, correlation goes to 1 for all asset classes, regardless of whether it's bonds or gold or anything. But during a slightly extended period, and this is Q1, you actually see equities down 20% and bonds actually up. So is QE and liquidity fundamentally changing things, or do you still believe that long-term fixed income will remain a good hedge versus other risk assets like equities?
Yeah, we think there will still be hedge characteristics. The number in terms of the the correlation, and that could change over time. But what we have found out is, particular for this more acute crisis type scenario, the central bank is still the first one to be able to put action together. The fiscal side usually required more of a Congress, kind of many different rounds of going back and forth. But for central banks, they are particularly tested, in the 2008-9 period, and then they pull out the playbook again very quickly in 2020. And so you see, not only are they pulling the QE program together, some of the liquidity backstop program. In fact, they've expanded that toolkit. And I've also mentioned that maybe zero is not the lower bound in many countries, and they can go lower, in order to help to resuscitate the economy. So that's still kind of providing that tail risk hedge to us. when some of the big events like this year happen, and we are still anticipating more of the disruptive factors to still be in play over the secular horizon.
Great. And, we are a big proponent of, diversification and hedging through fixed income, because we still believe that, many asset classes are inflated in terms of valuations. It's not just fixed income, it's not just equities. It is the result of the tide lifting all boats. But we've clearly seen the benefits of diversification, and you show it very clearly in the slides here that it does reduce volatility, reduces, improve risk-adjusted returns by simple diversification. Just going back to this question about, Asia and emerging markets, and to this chart, specifically the bottom right chart, where China is becoming increasingly dominant. There is a specific question on our Q&A about your views on the RMB bond market, but maybe you could just expound on that a little bit and talk about China's place in the Asian fixed income market, dominating the credit space now in corporate IG as well. But also high yield in Asia is becoming really a very hot, exciting kind of space, and PIMCO is very, very much present there, and you run the portfolio. So maybe a backdrop, and then China's place, and then do you have any views on the RMB local bond market as well?
Sure thing. So we are seeing China bonds in a kind of greater meaning sense, that across different currencies to have been a very robust issuance market and broader size to have increased over time. The typical GDP growth obviously is a big factor for that. And if you look at the actual bond market relative to its GDP size, it's still not where it should be. So we anticipate more of that to grow in the days ahead. So there are different ways that you can participate. There are US dollar credit issued by Chinese entities, which we are also very active on across both investment grade and high yield spectrum. And these would be bonds that are settled in a euro clearable, things that are very suitable for global investor. And they're also typically be under English law or New York law for rating agencies and other investor to also have the kind of transparency that they need to evaluate the instruments. So that this is an area which we have a big presence, and we continue to build up more and more credit research capability. We have 10 credit analysts across the platform in Asia Pac, and we're one of the biggest platform here. But still, we see the issuer number continue to go up, and we are investing in more in the days ahead. On the onshore renminbi bond market, it is also becoming more and more available for foreign investor. In fact, over the last few years, the big conversation has been how index provider, global index provider, are including China onshore market into their global bond indices. And this is not a trivial matter. The global aggregate, the Bloomberg Barclays global aggregate, the weight of China went from 0, let's say at the end of 2018, to now about 6%. There are other indices that would be going to roughly 10% or the cap of in terms of weighting for China onshore bonds. And they're only including the China government and some of the policy banks for now. So imagine that they were including more of their, even the state-owned enterprises and other high-grade corporate ones. So there is a lot more to grow in this space. And from our standpoint, the renminbi itself is also a currency that would help provide more diversification ahead. There is strong policy directive to internationalize that currency for more widespread use, maybe to prepare itself to at some point become a more reserve currency, and we have seen central banks allocating to renminbi over time as well. And more from a cyclical sense, we also favor the currency. We see the growth dynamics growing faster than the global average, or pretty much every major markets, major economy in the world. There is the interest rate differential, where, as I mentioned, 10-year yields or even front-end yields, they're yielding 2 to 3% above the US and other markets. And they also enjoy very strong current account and trade balances. So all of these factors are very supportive for the renminbi currencies to continue to perform.
Okay, thanks for that, Stephen. And we're running out of time, so maybe one last question. There's somebody asking about green bonds. So this whole ESG space and green bonds are the hot topic right now. Some people are saying that this is actually a factor, and so ESG will outperform as a factor going forward. We know that it's a self-fulfilling prophecy. If money goes into a certain sector, then obviously the performance is self-fulfilling oftentimes. But there is fundamentals and valuations and other reasons and other factors driving things. PIMCO, and just to let everybody know that we are not specifically talking about products, single products, but I would just give a plug that PIMCO did launch a climate bond fund last year, which is really good, and it's done really well and largely tracked the index and slightly beat it, I think. But just maybe, Stephen, just a macro comment about ESG. How much demand are you seeing? Are you getting a lot of interest and questions? And while you may have a global climate bond fund or a green bond product, is there something in Asia that we can look forward to, or in terms of the market developing into a meaningful size in Asia?
Yeah, I think all of them, the answer is yes. So if you look at fund flows, this year, the ESG related fund flows across the industry has been very much positive, both across fixed income and equity. And for particular for our kind of, when we look at the green bond day to day or companies day to day, and I might have mentioned that earlier, there are banks and there are clients with guidelines not to lend to environmental polluting kind of companies. So coal related industry, for example, they are having problems. Many of them having issues to even refinance their bonds. So PIMCO is at the forefront in terms of integrating ESG into our process. So for all the credit and companies that we looked at, we'll have the separate E and S and G ratings and commentaries around that, and that got feed into our various different strategy. And separately, the company itself can have the ESG component, but there are also specifically green bonds being issued. And there are also different green standards, and we have a dedicated analyst on ESG side to help us look through whether this standard is tight in terms of the use of proceeds for green related purposes. And we would then use that as a criteria, whether that should fit into our portfolios, or especially for the ESG dedicated portfolios. And I think this is something that we will continue to invest. We think we are already at the forefront, but ESG is something not only good for returns, particularly given the trend of this flow, but also something that people can stand behind and becomes more in terms of like philosophically, morally, kind of be more confident about holding it through the cycle.
That's great, Stephen. And Endowus is right behind you on that, because we're a very mission and value driven company. We believe that ESG will be a major component of wealth going forward, and we'd love to continue to work with PIMCO to bring great products in this space to market here in Singapore, and also when we launch in Singapore next year. We have a few questions, Stephen. I know we've run out of time, but on specific products, and I'd rather maybe just answer very quickly since it is a PIMCO webinar. There's some questions about GIS Total Return Bond Fund and whether it's a good hedge against rising inflation. Would this be a risky fund if interest rates increase in future? And I think the investor may be confusing the Global Real Return Fund with the Total Return Fund, which have slightly different characteristics. Stephen mentioned that it may be good to have some exposure to inflation hedging, exposure in fixed income, and that is the Global Real Return Fund. The Total Return Fund is more of a risk managed active manager trying to gain long-term capital appreciation returns as well. So it's much more active and core fixed income strategy So I think we can differentiate those two. And then another question asking about the difference between diversified income and income. And diversified income is largely a global but US centric and very heavily skewed to mortgage-backed securities in its allocation, a little bit opportunistic, but targeting about 4% yield. Diversified income actually has emerging markets and high yield exposure on top as well. So it is a little bit higher octane product in, from our perspective, providing, some, boost to yield and also returns over the long term by exposing to the higher risk and higher return segments of the fixed income market. And the third product in that range is a low duration income, which is short duration. So shorter maturity, so lower volatility and lower risk, hopefully. And the product is targeting about 2/3 of the yield. So if 4% income product is targeting 4%, then something closer to 3% is the kind of distributed yield that you would expect from a low duration income fund. So those are some simple questions, and we have a lot of questions on FundSmart and the UDP as well, which we launched today. So this is the product. The only question I'm going to answer is the weighting. And yes, we did adjust the weighting of the ultra defensive portfolio slightly as a result of cleaner data and also just optimizing the portfolio to give us a slightly better risk-adjusted return and lower volatility. But effectively, an equal weighted of the top four funds which is the original UDP thing that we showed when we launched FundSmart, is very marginally different. So if you already have an ultra defensive portfolio that you've created with the same four funds, that hasn't changed, but the weighting has changed slightly. There is no need for you to adjust it. It's perfectly fine for you to hold on to it. These are four wonderful, great funds that are supposed to do its job. Really low cost with institutional access, giving you low volatility and decent returns. And if you have appetite for slightly more risk, and especially with Stephen's presentation today, that we do see a benign kind of outlook with no sharp movements in interest rates in any direction. And we've seen the worst of the crisis related to COVID, and the central banks have moved and some fiscal actions have happened. It's probably unlikely that we will see even the 100% fixed income portfolio dramatically, move up or down, and it will probably be able to give you more stable returns over the longer term. And one final question was on the maximum drawdown. So these are all published in the Insights article that was published today. So please take a look at it, and you can go in and build this portfolio yourself. And a quick plug again for the webinar next week. And my final comments are to thank Stephen for joining us, providing us with your wonderful insights. And we're really excited about the continued partnership between Endowus and PIMCO. And we would love to have you back in the future at some point with a further update on your outlook and views.
Thank you very much. The pleasure is all mine.
Okay, thank you so much, Stephen, for being with us today. And thank you everybody for joining us today. Have a good evening.